traders, welcome to this video. Today I want to go with you through the 10 deadly trading sins. I posted them on Twitter some days ago, and I want to give you some more details and examples and explanations in this video. Before I come to the 10 deadly trading sins, I want to say that, of course, for every of those sins, you find a strategy where you can do the opposite. And of course, it highly depends on your experience and on your trading strategy if one of those points is a sin or if you are able to make a benefit from it in your trading strategy. But I see a lot of traders on social media, and I got a lot of questions around these 10 deadly trading sins, and I see many people on social media who are doing this. And I think if you are able to let go one of those 10 trading sins, you will have much better results in the long term. So the first one is removing your stop loss. Stop loss is always a large topic, and I made a video about that. You find it in my YouTube channel. But I also get some questions, especially around earnings or when a company reports earnings, if you should remove your stop loss, or if you, for example, move your stop loss up or down depending on the reaction to the earnings. And I think removing your stop loss is one of the worst things you can do, because your stop loss should make sure that you only lose a specific amount of money you predefined before you took the trade. And if you remove your stop loss order, then you have two big problems. The first one is psychologically, because in that situation you must rely on your discipline, and you must rely on your reaction as a trader. And this is very, very difficult, because the most people do not have this discipline. I mean, it's not a problem if you are a successful trader for 10 years, then you may don't use stop loss orders at all. Or if you can monitor your trading positions every second and every minute, then you do not need a stop loss order. But for the most people, you should definitely have a stop loss order in the market. And the second reason is you extend your losses. So if you, for example, planned to lose only $500 in case you get stopped out, and now you remove your stop loss order, and there is a high potential that you lose more than the $500. And in the long run, your average losses get bigger and bigger and bigger, and that will lead to very bad results. So removing your stop loss order is definitely a deadly sin in the long run. I want to give you an example, and this is Citrix. Citrix reported earnings 2 days ago, and you can see Citrix had a wonderful base pattern here, and it broke out of this base pattern here, and the reaction to earnings was a gap down. So this is bad per se, but it was above the base, above the breakout line. So maybe you now have your stop loss, or had your stop loss below the breakout line here, and you can see how fast this price broke through this breakout level and broke through the EMA 8 and the EMA 21 here. If you do not have a stop loss in place, you will definitely have a big loss here on that trading day. And if you are not able to monitor that stock the whole day, you look into your trading station at the evening after the close, and you are confronted with a big loss. So that's why it's very important, if you are not able to monitor your stocks all the time, to have a stop loss order. I experienced it a lot of times that intraday moves happened. For example, because a news was posted or the company had a conference or something, and then the price dropped extreme fast. And in this extreme fast situation, you are mostly not able to react so quickly that you get stopped out very fast. So stop loss orders will help you with that. Okay, just one comment maybe to this thing about hunting of stop loss orders. You maybe read that on social media, and and some people are saying that there are algorithms or market makers hunting stop loss orders from retail traders. If you have any reliable source where you have some analysis of this phenomenon, please email it to me. But I think this is just a myth, and this has nothing to do with reality. So if you get stopped out very often, then you should check your stop loss strategy and not and take the responsibility by your own and not blame other people. Okay, the second one, chasing extended stocks. Yeah, this is a phenomenon I also see a lot of times. Of course, people are attracted by rising prices, and some stocks are exploding to the upside very, very fast, and they get in and then get stopped out immediately on a first pullback. And this happens very often if you chase extended stocks. And I prepared an example here. This is Zoom. Zoom had some very nice rallies here, and you can see that Zoom also built a base here and broke out very quickly and ran up 3 days in a row here. And if you now buy the stock, say here at that bar, you definitely have a high risk of get stopped out on the first pullback here. And you can see it. So this is not the only example in a fast momentum stock. So if you buy here, or if you buy here, or if you buy here, you get stopped out. So you must make sure that you buy as soon as the stock broke out of a sound base. That means you should buy here at that level. This is a good entry point, so above the space breakout. And also this is a little bit extended, because you can see that the price already rose 2 days or maybe 3 days in a row before it broke out. This is also a little bit extended. And so if you get in too late, you will get stopped out. So don't chase extended stocks, don't chase stocks which are 5% or more above the breakout line. So that means here, something like that here. So 190 in that case. If you get in at 20% or even more above the breakout line, you have the high risk of getting stopped out. So don't chase extended stocks. Buying a rumor. This is another deadly trading sin. There is so many crap out there, so many rumors. Everybody posted something on social media. There are so many editorial offices posting articles about companies, etc. People love to talk, people love to chat, and they love rumors. But you as a trader, you should not base your trades on rumors. Of course, you can trade the price action of a rumor, but you should not say, okay, I buy that stock because it will be maybe taken over by another company. A good example is ROKU. I know the stock from ROKU had a nice rally here some days ago, but if you compare that here on 15th and 16th June, that was here, the rumor was out that Google maybe take over the company. And you can see what happened. The price went up, yes, of course, and then pulled back. So because the professional money, the people who really move the market, they do not buy rumors, they buy facts. And maybe some retail traders and some very speculative, news-driven hedge funds or whatever, they are buying such a rumor here. But you can see ROKU went up a few days, then pulled back, then another rally happens, etc. So buying on a rumor is not the best case. So maybe there are some examples in the past where one or two trades paid off very nicely, but in the long run, playing only rumors or buying trades because you see a headline is not a good strategy. That will not pay off in the long run. Extend your stop loss, or extending a stop loss, is very similar to number one. Extending your stop loss, so if you have a stop loss order in the market and you see that the price is coming close to your stop loss order, you should definitely not extend your stop loss. That means moving your stop loss far away from the current price. Some people are doing that because they are afraid to lose money, but in the end you will lose more money. The odds are much higher that a trend continues instead of that a trend stops. And if the price is moving against you, you already have a trend. You have a trend in the intraday charts, etc. And if you now extend your stop loss and give the trade more room, you are very likely to get stopped out, and you are very likely to get stopped out with a higher loss. So this is really not a good strategy, because in the long run your average loss will increase, and that will take your edge. So that will make it very hard to be profitable in the long run. Instead, if the trade goes against you, you should think about to tighten your stop loss, to get out with a very small loss and not with a bigger loss. Okay, the fifth trading sin, adding to a position before earnings. Of course, there are people who think they know everything and they have a good feeling about a stock, whatever that means, and they think a company will report good earnings, etc. But this is highly subjective, and earnings are a 50-50 play. So that means there is a 50% chance that it will, that the reaction will be bad, and there is a 50% that the reaction will be good. It is much more gambling as trading, and you should only hold on to a position over earnings if you have a large profit cushion. A recent example is Intel. If we look at Intel here, you can see it. Price was moving up a little bit. It was a weak stock in general, so maybe the market was expected some bad earnings here or bad news about Intel, and then you can see that it gapped down really, really hard. And if you now add it to your position before the earnings, because you thought, okay, the earnings report will be good, and the stock is sitting on a support level here, etc., then you extended your loss here. And this is a very, very big problem. So it is the same as removing your stop loss or extending your stop loss. You increase your average loss over time, and that will lead to very bad results, and that will lead to a very small edge in the stock market, or you lost your edge at all. So increasing position size before earnings is a highly difficult and risky situation. So another one, average down. This is something a lot of people commented also in my tweet of the 10 deadly trading sins, because they say, okay, when I'm a long-term investor, I average down, etc., etc. And averaging down highly depends on your strategy. That's true. So if you are a very long-term investor and you are always invested 100% in the market, then maybe average down is a part of your strategy. And if this is a part of your strategy, then it is, of course, okay to do that. But if you are in a losing trading position and you want to hold the trading position for some weeks or month, then the time period is much, much more shorter, as if you were a long-term investor holding an ETF or an investment fund for years. So in that situation, if you now average down, you increase your position size when the price is down. And when the market goes sideways, or when the market is going down, or stock is decreasing in price, you will lose more money. And that is the big risk of averaging down. So of course it looks attractive if your average entry price decreases, and of course it is very profitable if the price has a nice rally after you average down. But in the long run, and you must always look in the long run, you will have a lot of losing trades, and in that case a larger position size means always larger losses, and that will have a very negative impact on your trading at all. I want to give you one example I forgot here in my list, and this is the Nikkei index. And you can see, if I load now the Nikkei index in the monthly chart, you can see that the Nikkei went sideways for almost 25 years. So you can see that the market was moving sideways for 25 years. And this is, if you are now averaging down on every of those down moves here, it is very, very difficult to have a big profit on the up moves. So of course your average entry price goes down, but in the long run, say you have an average entry price above here, so 50% of this range, you will have only a very little profit. And every rebalancing strategy or every moving average strategy will have better results as an average down strategy here. I'm not an expert in that, but I definitely highly doubt that you will have a good result on an average down strategy in long term. And don't make a mistake, if you also look at say the S&P 500, which went up very nicely in the last years, it could be that you will have a similar situation as in the Nikkei, also in US indices. And you must also see that also the S&P 500 had some very, very serious drawdowns here. And holding on to those drawdowns is very difficult psychologically and also from the monetary view. Because if you are sitting in a portfolio and the portfolio went down 70%, it is very hard to hold on to that positions. And in that case, also if you average down, you are also sitting always in a loss. You know, you buy for smaller price, but every position you buy on the way down is a losing position. And if the losses get bigger and bigger and bigger and bigger in your portfolio, it is very hard to sit there and do not click on the sell button and realize a big loss here. So, or here. So, and Yeah, so think about that. This is a very, very difficult and a very risky game to average down. Spontaneous trades, of course, the seventh deadly sin. I think everyone did this, and everyone has a feeling about a stock or whatever and click on the buy button, and then the stock immediately moves against you. And this is very often spontaneous trades will not pay in the long run, because you do not follow a strategy. And the benefit of a strategy is to produce a repeatable edge, and with that you have consistent results. And if you now take every trade as a single trade and every trade based on feelings and spontaneous actions, you will not follow a strategy and you will not be able to produce consistent results, because every trade is completely different from the entry and the exit criteria. And it's much better to base your trades on analysis and on predefined criteria, which are able to produce a consistent outcome and consistent result over the long term. Okay, the eighth deadly sin, shorting volatility. Of course, if you are an intraday trader or a short-term trader, it sometimes makes sense to short volatility, but in the long run, that will not pay out. Here, for example, you have a vehicle, an ETF, UVXY. I know that's based on options, and they will have and the time will have an impact on the options. But let's switch to the daily chart. And what I mean with that, shorting volatility, is it is very difficult to short volatility because you get stopped out on one day. And you can see it here. So if you maybe short here volatility and you follow the trend, you will get stopped out here on one day. And this repeats often. You can see here that every counter move in a rally is very, very strong. And sometimes you also have the big risk of gap ups, because if here in that case the S&P 500 will get down strongly, you have the problem of gap ups in the volatility ETFs. And don't make a mistake, these moves are very, very big and very fast. So you can see this here is a 40% move. So if you do not have a stop loss or a good strategy in place, shorting volatility is a very, very risky game. And maybe you can remember the situation. There have been a lot of inverted volatility ETFs in the past. They are all gone, because in that situation, as the market turns to correct strongly, all those inverted short volatility ETFs are wiped out within a second. So there have been a lot of people who shorted volatility in the past, and they sat on 90% or even 100% losses in those ETFs. The only way really to short volatility is maybe by playing the VIX, so really the volatility index, maybe via a future or via an option or whatever. So, but this is, you can see it, you can compare it, UVXY versus here the VIX, or if you if you take the future from the CBOE here, that's the same. You can see the counter moves are very, very strong, and it's very hard to make money by shorting it over long term. Okay, big position sizes in biotech, number 9. So biotech is a very risky game because the most businesses are based only on expectations and they do not have a running business model. They only get income and they only get revenue from other pharma companies. And the big problem is, if you now look at biotech stocks, if you look into the biotech sector, you see a lot of trades and a lot of stocks which went up 100% or 200, 300, 400%. So, but this is really selection bias because you do not see all the biotech companies which went bankrupt because they are not listed anymore in this sector. And I saw a lot of biotech stocks dropping 80% or 70% overnight with a gap down. And if you now have a big position in such a stock, so something like 20, 30, 40% or something, your capital is wiped out within one day. So be very, very careful with biotechs and also with conservative biotechs. So always calculate your risk and your position size by the question, what will happen if the stock gaps down 20 or even 50% against me. If you now see you have a too large loss, then you know your position size is too big. I want to give you an example here from Biogen some time ago. You can see here a very big gap down here in the chart. It was 27%, and this is not a very highly risky biotech company. This is a established company in the biotech sector, and also those companies can have very, very large gap downs. So please be careful with committing big position sizes in biotech. The last and 10th point, shorting momentum stocks. Of course, if you have a strategy and a successful strategy with a proven track record and you are able to catch the right moment to short a momentum stock, go with it. But the most people will not be able to do this because if there's a very high demand in a stock and there are some emotions in the stock and some emotions are working in the stockholders and in the traders, some stocks can go to the moon. You saw that some months or years ago with stocks like, for example, Tilray was a cannabis stock which moved here 850% in a couple of weeks, and that was not a thin traded stock. That was a very liquid stocks. You saw that with stocks like Beyond Meat, for example, which also moved here 260% in a few weeks. And you can see it also from a recent example with Space here in 2020, a stock which moved 400%. And I will give you examples. So if you short here, if you short here, if you short here, or even here, your position will be really in big trouble. The only way to short momentum stocks is when they show topping patterns. So that when they really get a problem of continue with their momentum, and you see definitely some signs that the demand is over and supply is coming into the stock. This is the only way when you can short momentum stocks. But if you are shorting momentum stocks on the way up without any signs of distribution or that the price will turn around, you will be in very big trouble. Because those stocks can run 20, 30, 50 or even 100% in one day. And if you are in a short position, you will lose a lot of money. Okay, these were my 10 deadly trading sins. It was a long video now, but I hope you see some of the arguments why I put those 10 deadly trading sins on the list. And I hope that the examples helped you to get a little bit more insight into my thoughts about that. If you want more information and if you want to follow me, you can do it, of course, on Twitter, in my YouTube channel, on Instagram. And I recommend my free newsletter. I send it out every Sunday with trading tips and with 3 stocks from my personal watch list.